The Indian Rupee is strengthening against the US dollar for the third consecutive day. Last Friday, we saw the pair touch a low of 79.85. Today, it has touched a low of 79.62. The question is, what is dragging the USD INR lower? And more importantly, what does this mean for the Indian markets? Well, to answer that, let's look at the events that are unfolding. As of today, the Reserve Bank of India's Monetary Policy Committee has decided to hold the repo rate at 5.5%, but it is not the decision to hold the rates that is guiding the Indian rupee. Instead, it is the RBI's forward guidance. The central bank has adopted a neutral stance, which means that there will be no hike in interest rates in the near future. In fact, the RBI is open to lowering interest rates if the inflation cools down. This is good news for the Indian markets. When interest rates are low, borrowing becomes cheaper, which boosts economic activity. It also makes the Indian rupee less attractive for foreign investors. Remember, when you invest in India, you earn a higher return in US dollars. So if the RBI cuts interest rates, it will likely trigger a sell-off in the Forex market. As a result, the US dollar will fall against the Indian rupee. Now, do you think that the RBI will cut interest rates in the next policy review meeting? Well, if the inflation numbers are anything to go by, then yes, the RBI could very well cut interest rates. Let me show you some numbers here. Retail inflation has fallen to 5.88% in November, mainly due to a fall in food prices. Now, this is below the RBI's upper tolerance limit of 6%. It also comes within the range set by the Government of India. Remember, the RBI is mandated to keep inflation at 4% plus or minus 2%. So the inflation is under control. And with the new policy of focusing on retail inflation, the RBI has more room to cut interest rates. However, there are two risks that the RBI is carefully monitoring. Number 1, the inflation expectations. If people expect inflation to rise in the future, then they may demand higher wages, and if that happens, then inflation could pick up again. The second risk is the global economy. The recession in the US and Europe could impact India's exports, and if that happens, then inflation could rise again. So the RBI will have to strike a careful balance between these two risks. What do you think? Will the RBI cut interest rates in the next meeting? Let me know in the comments below. Well, coming back to the markets, the Indian markets are looking expensive. The Nifty is trading at a PE of 23.49. The Sensex is trading at a PE of 24.14. So the markets have already rallied a lot, and a lot of experts are expecting a correction. So if you have made good profits so far, then you can book profits. But if you have not, then it is best to hold on. Systematically invest in the markets. Don't panic and sell. That's all for this video. Thanks for watching.